Octavio, can you share your opinion on this trade? I'm looking to place a repeat for next week. You're buying 113.90. Okay, so I had that completely wrong. Let's change that. And you're selling 3 of the 1370s? All right. Okay, so this is opposite of what we did earlier in the presentation. We talked about the put ratio back spread as a way to maybe use as a hedge, but by itself with the 50 shares, it wasn't a good partial hedge at all. So this one, you've got a good break even down to 1349. That's pretty good. The risk is extreme because you've got 2 naked puts here at 1370 in this situation. You have a large profit range here, a potential peak here. In that case, yeah, it's taking on a lot of extra risk for a small return percentage-wise, essentially is my take on it, Octavio. You've got a good breadth of break even. I get that. You've got the maximum return here of the credit of 2085. That's great. It's got a long range of profitability at 2085. And if it falls more than you expected, I mean, I have to fall 90 points here, but then you'd be getting close to this maximum profit you could achieve where you start getting the benefit of the bear put by buying 113.90 and selling 113.70. You're getting the power of the bear put debit here. And that gives you even some gain here, hedging the losses that you're starting to take on the puts, but then they start to kick in. Good range of profitability, much too high of a margin and risk requirement, margin requirement and risk factor for my taste personally, and a small return on the position. Okay, management wise, yes, I know that there's ways to manage. I'm just saying up front, great, good monetary profit here, but it's taking on a lot of monetary risk. The margin requirement for the 2 naked put positions in that case. But it's got a wide range of profitability, of course. Yeah, and you can manage it different ways, but just taking a look at it that way, Octavio, it's too much for me personally. And that's me. I'm more conservative, but it's too high of a margin requirement for a little return in this case. It's a ratio spread. Okay, it's the standard ratio put spread, just like a ratio call spread will have that infinite risk the other way. But you could set those up if you're bearish on the positions. You could flip this and do buy 1 and sell 3 deeper out of the money calls. So you'd have 2 naked calls, of course, and then that 1 bear call. I'm sorry, bull call debit spread in the mix there. But the infinite risk to the upside would require a high margin requirement for a potentially small return. They already passed earnings here? You're looking at May 6th. And, okay, good. They already passed. Yep, they had it in April 26th. The CMG is going to be there, so that's not a concern on the position. So, it's got a great range of profitability. Don't get me wrong, Octavio. Just, I'm a little bit more conservative. You know that by coming to these presentations. I just don't like sort of the risk-reward factor I'm seeing here up front. Yes, it can be managed, of course, if it starts to get into trouble. I understand that. You could close the 2. You could make adjustments. But, you've got the small credit up front here. If the stock starts falling here quickly, 90 points, if it falls to this point, let's say on Wednesday of next week, these are still going to be pretty expensive to buy to close. You're going to get some value out of this, don't get me wrong, but those 2 extra ones to buy to close, they're going to be pretty expensive as you're getting closer to at the money on such a high price stock. Even if you're getting close to expiration, it's not going to be 20 cents or 30 cents. It's going to be $20 or $30 in this case. Okay. So, yeah, it's like I said, good probability of success. Good range of profitability. It's excellent. Very low break even, point to break even. That's excellent. Risk reward a little bit too much for my tastes. So I don't know if I would put that. That's where I am right now. Yeah, you have an accelerated. You have almost a guaranteed profit. I hate to say that, but yeah, guaranteed profit of 2,000. Yeah, the potential to make more, but that's going to start when those prices are going to start fluctuating on you. But you're going to get closer to that max return. I get it, and it's a shorter time frame, which is great as well. For the structure. This is not something I might want to do for 70 or 80 or 90 days out, although I might have a higher net credit in and a higher potential max profit because of that structure and the higher premium. But being shorter term, I think, is better, less time for the stock to move against you to get the position into trouble. So it's a 3-to-1 ratio spread, standard ratio put spread is what we're looking at. High risk to the downside, of course, but that maximum risk here, that's only if the stock goes to 0. Not expecting that to happen. And I said, of course, that earnings were a couple days ago, but I said, of course, that, it has to fall almost 100 points here, a little bit more than 100. Sorry, it's 106. I think I said 90, but it's about 106 points. But again, we dropped 45 points today. If you drop another 50 on Tuesday, another 40 on Wednesday, of course, you're going to be really close. But that's where you want the profitability range to be, is you're getting closer to expiration as well, which is great. Don't think it would drop all. I'm sorry, no, now you're getting closer to the break even. I'm sorry, not the max profit. The max profit's at 1370. Sorry about that. So, with a 45 point drop today, it sounds like but we are in a negative day today, and we've seen that, of course, from time to time. But today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. Options involve risk and may not be suitable for all investors. We didn't look at too many tools today. We looked at the search and played around with it for a little bit. We showed how to customize it, look for one stock at a time, use it to show the annualized returns of the different expirations and so forth. Did take a look at the portfolio tools a little bit, but we did not take a look at the rollout opportunities. But of course, if you want access to patented search tools, use our defaults or create your own search. Backtesting tools are available as well. The portfolio, you can start your free trial at any time. Just go to poweropt.com, put in your name and email address, and you have full use of the site for 14 days. After that, the subscription levels start at just $45 per month, the monthly subscription for the end-of-day data. And of course, you can cancel at any time. The 20-minute delayed service is only $65 per month. Free coaching is available on all level of subscriptions. You can upgrade your subscription at any time. And of course, subscribers get full access to the webinar archives. Speaking of which, at any time you can access our various archive webinars, free education. You can go to the archive webinars page when you're logged in. Underneath the main home tab there, you can click on free webinars and go through the various tools, strategies, options, concepts, and more. Or, of course, you can also go to our YouTube channel, as we pointed out before, and scroll through the videos and scroll through the playlists there as well. If you do think of any other questions at any time, remember to send me an email to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Remember, trial members and subscribers can schedule a free coaching session at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie. Walk you through the tools and site and answer any questions that you have.